Unemployment hit 4%. Guys, wake up, smell the coffee, Jerome Powell. It's time to wake up, sir. 4% was his guidance by the end of the year. We're mid-year 2024, June, 4% unemployment. Data's coming in where we need to come in. Is it time to cut? Is the Fed asleep at the wheel again? Is the Fed lying to us? Is the Fed gonna be late to the party? Remember, folks, in 2021, the biggest regret, the biggest failure of this Fed is they thought inflation was what? Transitory. And what happened? They were a one year, 365 days, however you want to say it, late to start raising rates and recognize that we have a serious problem in this country with inflation. And then they jacked the rates up 500 basis points in a year. And here's the results. It's clear as day. Unemployment reaches 4%. The consumer is slowing. The jobs that are even being had, that are getting done, look at them. Look at them. The government's making up a lot of them. Why is the government hiring so much? Does anybody know? Because they're spending money they don't have. Is anybody seeing this pattern, folks? That's just the data. But what I'm hearing on the streets on every day in my business and the people I get to talk to that are owning small businesses, whatever they are, I'm hearing pain, especially here in California. This new $20 an hour, I'm hearing pain. I'm hearing people at the end of the rope. I'm hearing restaurants are struggling big time. I'm hearing that these things are only gonna get worse and worse and worse, and eventually something's gonna give. So folks, the further we get away from the pandemic, the further we get away from all the government spending, the further we get away from the money printing, do you notice one thing? And I'm noticing it, and I'm wondering if you are. I'm noticing the further away from all that stuff, which is all that money and all those payments you have to make and all that locked up business and all that overspending and all that credit card debt and everybody burned through their savings, we're noticing one thing. We're noticing an economy that is slowing. We're noticing unemployment ticking up. We're noticing, yeah, great, we got a jobs report of 272,000. If you watch my information, you watch my channel, you watch my content, you will know that I think the jobs reports are a bunch of baloney. It's a bunch of BS. Why? Because 11 out of 12 last year, just last year, and even coming this year, they keep getting revised to the downside. That means last year, according to the jobs report, when they got revised, there were 600,000 jobs off. Let me repeat, 600,000 jobs they overestimated. If you divide that by 12, that's 50,000 jobs a month. And why am I saying all this? Because bad news is good news for what? For real estate and interest rates. And we want rate cuts. So a lot of people now are starting to come on the offense and proactive and saying, you need to cut rates in July and get the party started. Will Mr. Powell do that? I doubt it, because he loves to be late to the party. He is going to be late to the party here again. He wants to see more pain in the jobs market. He wants to see Americans lose more jobs. He wants to see inflation to keep coming down. But in order to do that, we have to stop spending money like a bunch of drunk sailors at the feds and at the government. They are printing money. But like I said, is who's hiring these people? Let me just make one more little tidbit of information you need to know. Did you realize that in 2008-9, one of the reasons we went into recession like that right away is because over 1 million people lost their jobs in what sector? Can anybody guess what sector they lost their jobs in? If you said the construction sector, you're absolutely right. So what's different from this time? You might ask, Kenny, wait a minute, that's a good point. Why haven't those people lost their jobs? Because construction's way down. They're not building apartments that are being built. They're gonna go from 600,000 this year to 400 to 200,000, and we're just not gonna build anymore. The builders are slowing down. People are not remodeling and doing as much stuff they are. They're just not, folks. Trust me, here where I am, a lot of people are kind of hunkering down and not doing as much stuff. So where are all those people employed? Well, guess what? 1 million construction workers got hired. Where do you think they got hired to? Guess what? all that infrastructure spending, right, on plants and across the country, 1 million construction workers are put at work. If we were not spending that money as a government, maybe we need to, maybe we don't. My point is, if we were not spending that money and hiring 1 million of them, we would be in some serious problems because we'd have 1 million contractors unemployed. We would have a recession. That employment number would be higher. And a lot of people think that unemployment number is BS. It's not real. It should be higher. So we're going to find out. But what this really means is we are moving closer and closer to where Jerome Powell is going to feel confident, where he can what? He can basically cut rates. We can cut the rates. We know that interest rates can start lowering. We can start getting back into a more healthier, right, normal real estate market where you could actually sell your house and find another house, or actually in some markets there's not a bidding war and people might feel more comfortable to refinance their 6, 7, 8% mortgage rates, and people might feel good to, hey, I gotta sell my house but it's at a 3% to go buy something and maybe I can live with a 5%, right? So we need to get some fluidity in the housing market. The only way to do that is interest rates. And speaking of a crisis or depression, commercial real estate is even worse. So we need interest rates to come down just to even start saving that sector, because that's going to be a drag down on the economy coming up, a drag down on the banks. And remember, guys, banks lend money. And remember, 80% of stuff that gets done, meaning that gets like funded, is from debt, like credit card, loans, and things like that. So if banks aren't lending, things aren't getting done, money's not getting spent, we have a major, major problem. But hey guys, welcome back. It's another week. My name is Kenny Simpson. Welcome. Thanks so much for watching. I'd love to hear you below. Give me some comments, like, subscribe to the channel. Also, if you want to reach out, in the show notes, it's all down there. You know how to reach me. Set up a call, text me, email me, however, ring me, whatever. I got your back. I want to meet with you. I want to answer your questions. I want to help you out. If you don't know who I am, if it's your first time here, I focus on 1 to 4 unit financing. I've been doing this for about 20 years, helped over 5,000 customers, funded $1 billion of loans. So if I can help you, I would love to help you, because that's why I'm here. I do a lot of content. That's why you're watching this. So go ahead and follow me on Instagram. Also, you should go below and sign up for my weekly emails, because if you're not on my email list, boy, you're missing out, because there's some real good stuff there too as well. But anyways, back at it. For those of you that are continuing to watch and support me, thank you so much. If I can help you in any way, please reach out. So as we always do every week, let's get into it, folks. Enough about the drama, enough about the feds. We already know they're screwing this up. We already know they don't know what the hell they're doing. It's clear. Inflation's come way down. The jobs market's starting to crack. The consumer's cracking. Corporate earnings are there. I'm hearing people that are on, real business owners on the ground, really, especially in a place like California, really starting to struggle. The labor laws, the insurance, everything, the margins are getting thin. And so I can clearly hear the frustration, the pain in their voice. And I think that, how is a consumer from here going to get stronger? If they're struggling right now and the economy gets any worse and you're a small business, how does it get better for you? I just don't know. Or even lower rates, can it make it better? I just don't know. So it's really, and we're going to have to see and determine what happens in the future here. But look, a recession for real estate typically means people lose their jobs, maybe more inventory. But more importantly, what everybody wants to hear is it lowers rates. So that would help home buyers, help home sellers, because home sellers are stuck in those low rates, help real estate investors, help the commercial market. It will help business owners, HELOCs. It will start getting stuff moving with lower rates, because a lot of people do not want to do anything when rates are at 8, 9, 10+% on certain debt. This article is written by Mike Simonson at Housing Wire. If you don't know about Mike Simonson, we have him on the podcast. He is the genius. He is the data guy. So he is the guy that figured out how to get all the data from all the houses and all the markets and give us weekly updates. I don't think there is anybody better to give us data. So I'm going to go to this quick little article about him talking about what's going on with inventory. Some markets we're hearing it's growing. Some markets we're hearing it's stagnant. It's not growing. Nationally, we're hearing it's growing. Let's see what he has to say. Let's jump into it real quick. Home prices are slipping in Florida, Arizona, and Texas. Altos is expected to end the year with about 625,000 single-family homes in the market, which would be 19% more than a year ago. That's good. There are now 605 single-family homes in the market. Inventory continues to build each week as mortgage rates stay over 7%. Inventory rose by 1.7% this week, and there are now 39% more homes, 170,000 in the market than there was last year at this time. That's a pretty big increase. A couple of factors about the inventory increase. Inventory is climbing everywhere, every state, everywhere. Every state has more homes for sale now than a year ago. Most of the country has over 30% more homes on the market now. A few states, Texas, California, Florida, Georgia, and Arizona are driving the bulk of the inventory increase for the country. Well, California is such a big market, I would see that for sure. Higher interest had led to greater inventory. So on the other hand, inventory can't build too much if sellers don't sell. That's true. There are some signals of seller volume drying up. There were only 62,000 new listings this week. That's down from 12% on the week, which includes Memorial Day. Every year has a dip in activity in the holiday. But I think it's notable that the holiday weekend dipped for last year than it's normal. Expect big inventory gains over the next 4 weeks, then a breather for Independence Day, then another bump in July before tapering off at the late summer. We're currently modeling inventory to peak in October, and that model is very interest rate sensitive. If rates are climbing late in the year, inventory will climb too. If rates fall before then, inventory will turn down earlier in the summer too. We're currently expecting to end the year at 625 single-family homes in the market, which is 19% more. So, in his final sentence, home buyers are obviously sensitive to the cost of money, and mortgage rates stayed higher for longer than anyone anticipated this year. They haven't come down yet. What if they do? If you aren't watching the data each week, you probably are behind on the curve. You have buyers and sellers who have no idea that this market is changed right now. It's true. So that's a little bit of update. So it looks like Florida, Arizona, and Texas is getting the most inventory, and they're having slippage. So we will continue to watch. We will continue to report. Mike, thanks for that update. Always love seeing your guys' content. All right. Big week for data, folks. Another big week. Last week was big. We kind of broke it down. The jobs report was stronger, right? But then some stuff's coming in okay. But look, here's the thing is, nobody's buying the jobs report because they keep getting revised down. Nobody's believing these jobs. If out of 270,000 jobs, 70,000 were government new jobs, the government is on a hiring spree because they have all this new money. But what happens if they don't have money? What happens if they stop hiring? So we all know that this is a big part of it. Hospitality, retail, that kind of sector is still hiring. But if we have a recession, that will fall off a cliff. So we're going to continue to monitor. But look, we know overall, if unemployment's rising to 4% and ticking up, we do understand that that's not a good thing, but it is a good thing if we want rates to come down. $17 trillion. There is $17 trillion in home equity these days. That is another good and bad problem. That's good because a lot of people are sitting on a lot of equity. They've got good fixed rates. They feel rich. The stock market's high. Their 401k is good. They're feeling good. The bad part about that is people can go tap into that equity with lines of credits, cash out refis, things like that. And that just keeps the economy going. So there's so much equity they could sell. They could cash out on an equity line, whatever. And they can use that money to keep stirring up the economy. So there's a lot of money that's sitting there that could be tapped to stimulate this economy and keep inflation higher than longer. So people might be using their equity lines to pay off credit cards or keep their lifestyle going. So eventually that does cause pain and causes a problem. So 17 trillion is a lot, but it does concern me. People can keep tapping into those, to that funding and creating a lifestyle which is unsustainable, which could cause problems. So for all my real estate investors out there, from last year to this year, I'm noticing a big difference. I know real estate investors here last year, they're kind of chilling, sitting on the sidelines, especially the 1 to 4. This year, I think because the consumer, and they've seen it, where we've learned to live with higher rates, and people realize like if rates don't go down, they're still gonna have to buy a home or refi. And remember, you date, you mate, you get married, you get a job, and you need to get out of that 1-bedroom apartment. You need to get out of that 1-bedroom condo. You need to go buy a house, a condo, a 2-unit, a 4-unit, whatever. And you're going to go out there, and 4 or 5 million people do this a year, even if you go, nobody's buying, nobody's doing anything. Well, folks, that's not true because millions and millions of people are doing something. So For investors, from this year, last year, investors jump back in. Real estate investor activity is up 0.5 from a year ago. To me, I think it's sector by sector. I'm seeing a lot more activity with people I know being definitely much more active, much more positive. They're obviously, you could be filling your pipeline, buying homes, flipping them, getting ready. But if rates come down, there'll be a good time for these investors to bring property on the market. It's the first increase in activity since mid 2022. So get a couple fun statistics. Real estate investors purchased about 44,000 U.S. homes in the first quarter of 2024, up from 0.5% a year ago. To Redfin, a real estate brokerage, the first increase, like I said, since 2022. So in the first quarter of 2024, the share of homes purchased by investors was 19% according to Redfin. That implies that around 81% of homes by our measures are being purchased by people who are not investors that are living in them. So that's kind of the balance in these days. Institutional operators, real estate investors own at least 1,000 single-family homes or more, own about 1% of the total housing stock in the U.S., according to an analyst from research site Resi Club, based on data from Parcel Labs, a real estate data firm. So if you look at this chart, it's pretty interesting where the investors are buying, not buying. A lot of activity in California, some activity in Florida, Georgia, things like that, these states. So it looks like West and then Southeast is big for the investors. So pretty interesting to see this map. It's up on the screen here. So investors making their way, feeling confident, coming back in the market. I'm seeing it here locally too as well. So 36% of Americans that were polled think real estate is the best long-term investment. And here's the easiest way to get started. I love this article. So 36%, and then above stocks or mutual funds. And then mutual funds were 22%, gold was 18%, and savings account or certificates of deposits was 13%, according to a recent study by Gallup, a global analytics and advisory firm. Real estate investment trust can be a great way to get started as they have a lower barrier to entry. And it is true. You could invest your money into a REIT. You can give your money to a syndicator if you can qualify. There's many options. Or you could just do it yourself. So obviously 36% of Americans feel like it's the best long-term strategy. There's a reason why 90% of millionaires own real estate. It's for tax strategy, cash flow, equity. Honestly, real estate is probably the best investment on the planet long-term. If you buy it, hold it. If you manage it right, you can do really, really well. So how could you get started with real estate investing? A couple tricks, now a couple hacks. Number one is get pre-approved by a lender. Number two, work with a real estate agent that specializes in real estate investing. So if you want to buy a 2 to 4 unit, go down that road. And number three, just make sure you have a really good team, whether that's comprised of, your lender, your agent, probably a property management, your insurance person, a real estate investor, or contractor. So if you are going to get in that game, it's different from your home, because if you buy a home, you buy an investment property, you need to be fixed. You need that dream team around you. And last but not least, consider this: maybe buying a 4 unit, living in one and renting out the others. That is an investment property because you're getting cash flow to offset your mortgage. What a great way to house hack. And long term, you could get out of that property, rent it out, pay it off. It could be an annuity for you. You could pass it on to kids' generations. Kids can move in it. Maybe they're going to live near you. Then you can go buy your home. But real estate investment is tried and true. It's really good. It's done wonders for us. And it's done wonder for so many other clients that I know. And especially here in California, people bought homes for $200,000, $300,000, $400,000, $500,000. Now they're worth multi-millions. It's changed their kids' lives. I've seen so many people that built, 30 unit portfolio, 50 unit, 100 unit portfolio. Somebody passed away, and there's kids that are still getting generational wealth, generational cash flow from that investment. And that grandparent has helped, his grandkids for the rest of their life, and that can keep getting passed along as long as you maintain it and you learn about it and you do it right and you take care of the property, take care of your tenants, and make sure you pay attention to what's going on with your cash flow and expenses. And last but not least, this week, I thought this article was great. I wanted to bring it up. I thought this was amazing that this lady that I'm going to jump into was $460,000 in consumer debt and student loan debt, and they paid it off after 10 years, and then they went back and bought a house. This is not for everybody, the sacrifice, but they did not want that burden sticking around for the rest of their life, so they just paid it off. They hunkered down. They really tackled it and got after it. So The article states we're in debt up to our eyeballs. Here's how we dug ourselves out of it and bought a home.
Now, Jade, great to see you. What the heck does Gen Z do? What's step one?
Good to see you again. Listen, Americans are in $1 trillion of credit card debt. So we haven't set a great example for these young Americans. Not to mention, like you said, they're really dealing with the issue of the rent to income ratio. It's out of control. Rent is too expensive for them. And so the thing that they've got to realize is they can't depend on credit cards, right? They're being marketed to, they're seeing on social media, right, this is the life that you should have. But credit cards simply are not the solution. At the end of the day, they want your payment. They don't want your peace.
Jade, I know that you're really not going to like my comment, but work with me for a minute. I know your theme is you get out of debt, and I hear you. But I have a lot of people that come up to me and they say, but what about growing my wealth long term? I'm missing out on the AI trade, the NVIDIA, the NASDAQ was up 40% last year. Is there not a little bit to be said about also, along with paying off your debt, maybe investing in the market, which is a good way to grow your wealth long term and take advantage of some of the upswings that we're seeing?
You know, that's a good thought, but we've seen that focused intensity over time is truly what creates momentum. And so we want Americans, if they have debt, we want you to focus all of your extra income on that debt so you can clear it out as quickly as possible. And then when that debt is cleared, you'll also have freed up income so that you're going to actually be able to invest far more than what you were investing before. We would recommend about 15% of your gross income every month going towards your investments once that debt is cleared. So you'll make it up.
Jade, the biggest problem to me is this notion that Americans, Gen Z, even some of the boomers, they have trouble living within their means. If they could live within their means, some things are out of their control, like very high rents right now. But even still, they could get a lesser apartment than they think they deserve, for example. If everybody would just sort of get with that culture, that philosophy, then they probably wouldn't go into debt in the first place. But why is it as a nation that we have such trouble doing that?
Absolutely. My colleague, Dr. John Deloney, would say we've got to choose reality. And for many of us, reality is I'm not earning enough to keep up with the lifestyle that I want. So in many cases, this is an income issue. And, you know, we do talk all the time about getting on a budget. You need a plan for your money. But the truth here is a budget is not a magic trick, okay? You've got to add money to it in order for it to create the lifestyle that you want and in order to make those numbers balance. And so there is a way to make this happen. And for a lot of people, it means getting extra income in order to supplement that budget.
Got to get rid of the unreality lifestyle you see on social media. Yeah. Choose your own. And then focused intensity. I took notes.
I love this article by Jade Warshaw, basically talking about how her and her husband, that when they got married, they had $460,000 in debt, consumer debt, and basically in student loans, and they paid it off, I think, within 10 years. And let's go through how they did this. Reading through this, first what they did is they sold their condo. They basically moved into a condo. Then they moved into another condo where they rented both of these. They basically split a condo with another married couple, so lived super uncomfortably on a blow-up mattress. Not fun, but they did not want to start a family, start their lives off with $460,000 of debt and buy another house. So they paid off all their debt. This is how they did it. For us, renting was necessary to step into the journey to homeownership. It bought us time that we needed to pay off our debt and save up to buy a home the right way. In truth, our goals were very simple in concept, but very difficult to accomplish. But if we can do it, you can do it here. These were our goals. So save $1,000 for emergency fund, pay off all debt, save up to 3 to 6 months of basic expenses. Make sure we're playing with a stacked deck. Here's what I mean by deck. And deck has to go with buying a house. I love this part. D stands for down payment. Save at least 5% if you can't hit 20 to avoid PMI. Guys, if you have good credit, PMI could be $75 a month. Earnest money. You will need, yes, earnest money. That is when you get into a contract, you put money in escrow, so you definitely need that. Closing costs. Closing costs can be around 5% of the purchase price. They're usually rolled into your mortgage loan. That is not true on a purchase. You got to pay the closing costs outside, so you got to put your down payment 5%. Let's say closing costs are another 5%, so that means you have to have 10%. And then K stands for keep in mind and save for miscellaneous expenses like inspection, appraisal, and actual move. Yes, there's closing. There's remember, there's your down payment, there's your earnest money, there's closing costs, there's expensive to move. You get to the house, you got to have emergency fund. What happens if the hot water heater breaks, or this happens, or that happens, or roof leak? You got to do it. On top of that, you have to, maybe even on top of that, prepare your budget, practice your budget. If you buy a home, it's a little bit more. Be prepared that water, electricity, things like that, it could cost more money than a 1-bedroom condo to run that entire house. But I love this overall, this article. She did kind of leave it with, this could take a long time. Don't be afraid of long timelines. Time passes fast. Plus, why not put yourself in a winning position to buy a home, to win the home you want, and do it the right way. So I do love this. A couple things I might disagree with, but overall, great story, great concept. And if you are, another hack here, if you're looking to buy a home, get in a home, and you have debt, or you're trying to save up money, consider that Uber or side hustle, even if it's for a year or two, to do that. We have a lot of people come through here that did side hustles to save up the money or pay off debt to buy the home, to put them and their family in a better financial position to buy that home or investment property, whatever it may be. Anyways, guys, thank you so much for watching. Please comment below, hit me up, like, subscribe, share this with somebody that might like it. Otherwise, have a good week. We will talk to you soon.